$500 more per month. That is the number making headlines right now, starting in February. Millions of Social Security recipients are being told they could see their monthly payments jump by as much as $500. For anyone living on a fixed income, that sounds life-changing. An extra $500 could mean catching up on bills, covering groceries without stress, finally breathing a little easier at the end of the month. But here's the part nobody is explaining clearly. Most people will not see anything close to $500. And if you don't understand exactly how this increase works, you could end up confused, disappointed, or worse, making financial decisions based on the wrong assumptions. Because this isn't a flat raise, it isn't a bonus check, and it definitely isn't automatic for everyone. The truth is layered, technical, and buried inside rules most people have never been told about. So the real question isn't, is there a $500 increase? The real question is, who actually qualifies? How is it calculated, and what will truly show up in your bank account? And before you assume you know the answer, there are a few details that might completely change your expectations. Hi, I'm Susan Harper, and I spend my time breaking down Social Security updates so they actually make sense for real people trying to manage real retirement budgets. My goal is simple: cut through the headlines, remove the bureaucratic language, and explain what these announcements actually mean for you personally. Because when it comes to your benefits, small misunderstandings can cost you thousands over time. Today, I'm going to walk you through exactly what this $500 increase really represents, who qualifies for larger adjustments, why most retirees will see a much smaller change, and how factors like Medicare, premiums, and claiming decisions could dramatically affect what you actually take home. By the end of this, you'll know precisely where you stand, and whether that $500 number applies to your situation or not. Let's start with the number everyone is talking about, and break it down in plain English. The foundation of this entire announcement is the annual cost of living adjustment, better known as COLA, for this year. The COLA is 2.5%. That means your Social Security benefit is increasing by 2.5% to keep pace, at least in theory, with inflation. Now, here's where expectations start to separate from reality. The average retirement benefit right now is roughly $1,927 per month. If you take 2.5% of that amount, you're looking at an increase of about $48 per month. Not $500, about $48. And I want to pause there for a moment, because this is where many people feel blindsided. They hear a large number circulating online. They assume something dramatic is happening. And then, when their deposit hits, the change feels modest. That's because percentages only feel powerful when the base number is large. Now, let's say you're receiving closer to $20,500 per month. A 2.5% increase there equals about $62. If you're receiving $3,000 per month, you're looking at about $75 more. Even at the higher end of the benefit spectrum, the math still doesn't naturally reach $500 from COLA alone. So if the standard adjustment doesn't create that kind of jump, where is the larger figure coming from? This is the critical distinction. The $500 number is not about a single benefit increasing by 2.5%. It applies to specific individuals whose total combined Social Security-related payments increase across multiple benefit streams at the same time. And this is important if this breakdown is already helping you see through the headline confusion. Make sure you subscribe so you don't miss future updates like this. Social Security changes constantly, and understanding them early gives you an advantage. Now, let's keep going to understand How someone could approach a $500 monthly increase. We have to look beyond a single retirement check. Social Security is not one uniform payment system. It's a network of benefit categories layered on top of each other. Depending on your work history, marital status, disability status, and family circumstances. For example, someone who earned at or near the maximum taxable income for most of their career could qualify for a much higher base benefit in 2025. The maximum benefit for someone retiring at full retirement age is $3,122 per month. A 2.5% increase on that amount is about $96. That's meaningful, but it's still nowhere near $500. So let's go deeper. Imagine a retiree who receives their own retirement benefit and also qualifies for survivor benefits from a late spouse. Those benefits can interact depending on which amount is higher. And in certain cases, adjustments across both categories can create a larger total monthly shift. Now consider someone who receives Social Security, disability insurance, and later transitions into retirement benefits, while also qualifying for auxiliary benefits tied to a spouse's record. Add in supplemental security income for individuals with limited resources, and suddenly, you have multiple benefit streams adjusting simultaneously. When each one receives a COLA increase, the combined total can become significant. There are also disabled adult child benefits, widow and widower benefits, and certain family maximum situations where multiple people in one household receive payments based on a single worker's earnings record. When you add up percentage increases across 2, 3, or even 4 payments tied to one household, that's when numbers can start climbing towards several $100s in total monthly change. But notice what's happening here. It's not that one person's retirement check jumped by $500. It's that multiple payments adjusted at once, and the aggregate increase is being described in headline form. Another scenario involves individuals who delayed claiming benefits until age 70. Maximizing delayed retirement credits. Every year you wait past full retirement age increases your benefit by 8% up to age 70. That permanently raises your base benefit. So, when COLA is applied to a higher base, the dollar amount of the increase becomes larger again. This still may not reach $500 on its own, but when combined with other eligible benefits, it can push total household increases into that range. And here's the key takeaway I want you to hold on to. Qualification for a larger increase depends entirely on your personal benefit structure. It depends on whether you're receiving one payment or multiple. It depends on your lifetime earnings. It depends on whether you claimed early, at full retirement age, or at 70. It depends on whether you're widowed, divorced after a long-term marriage, disabled, or caring for a dependent who qualifies under your record. The Social Security system is layered, and the math compounds. This is why blanket statements can be misleading. If you're receiving only the average retirement benefit and nothing else, your increase will likely be modest and directly tied to that 2.5% adjustment. But if you're in a more complex benefit situation, especially involving survivor benefits, disability, or your combined adjustment could be far more substantial. In just a moment, we need to talk about something that often shrinks these increases before you ever feel them: Medicare premiums and other deductions that quietly come out before the money hits your account. Because what shows on paper as an increase doesn't always translate into what you can actually spend, and that distinction matters more than most people realize. Now we need to talk about the part that almost never gets equal attention in these announcements. And that's Medicare, 'cause while your gross Social Security benefit may be increasing by 2.5%. What you actually receive in your bank account depends on what's deducted before the money ever reaches you. For most retirees, Medicare Part B premiums are automatically taken out of their Social Security check. For 2025, the standard Part B premium is $185 per month. If that premium increases from the previous year, it reduces the net impact of your COLA adjustment. So, even if your benefit rises by 48, 62, or even 96, part of that increase may already be spoken for. And this is where many retirees feel confused, or even frustrated on paper they received a raise. The Social Security Administration will show a higher gross monthly benefit. But when they compare their new deposit to last year's deposit, the difference may feel smaller than expected. That's because the increase in Medicare premiums offsets part of the gain. There's also something called the hold harmless provision, which is designed to prevent your net Social Security payment from going down. If Medicare premiums rise more than your COLA, in simple terms, your check generally won't shrink because of Medicare increases alone. But that doesn't mean your increase will feel meaningful. If you were expecting a noticeable jump, and instead see only a modest bump after deductions, the emotional difference can be significant. For higher income retirees, there's another layer called IRMAA, the income-related monthly adjustment amount. If your income exceeds certain thresholds, you pay higher Medicare premiums. That additional cost can reduce your effective increase even further. So, two retirees receiving the same gross Social Security benefit could see very different net deposits, depending on their Medicare premium level and tax situation, and taxes are another piece of this puzzle. Depending on your total income, up to 85% of your Social Security benefits can be subject to federal income tax. Some states also tax Social Security. If you've elected to have taxes withheld directly from your benefit, that withholding may slightly increase as your benefit rises again. It's not dramatic for most people, but it's enough to narrow the gap between headline numbers and real-world dollars. This is why I always encourage people to focus on net income, not just gross benefit amounts. What matters is what you can actually spend each month. When you're budgeting for groceries, utilities, housing, and medical expenses, it's the deposit amount that determines your flexibility. So, as you review your new benefit statement, look closely at both the gross benefit and the deductions. Understanding that full picture helps prevent surprises. Now, let's talk about timing, because another common misunderstanding revolves around when this increase actually shows up. Just because the adjustment is effective in February doesn't mean everyone receives it on the same day. Social Security payments follow a staggered schedule based on your birth date. If your birthday falls between the 1st and the 10th of the month, your payment typically arrives on the second Wednesday of each month. If you were born between the 11th and the 20th, you're paid on the third Wednesday. And if your birthday falls between the 21st and the end of the month, your payment arrives on the fourth Wednesday. There's also a separate category for individuals who began receiving benefits before May 1997. Those payments are generally issued on the third of the month. So, depending on your birth date and when you first started receiving benefits, your February deposit may land at a different time than someone else's. The increase is effective for everyone at the same time, but the calendar determines when you physically see it. This staggered system doesn't change how much you receive, but it does influence when you can expect the updated amount. And if you're planning expenses or making financial decisions based on the increase, knowing your payment schedule prevents unnecessary stress. I've seen retirees worry that their increase didn't happen simply because they checked their account before their scheduled payment date in the next part. We're going to step back and look at something even more important. How the claiming decisions you made years ago are still shaping how much you benefit from adjustments like this. Today, because the size of your increase isn't just about this year's percentage. It's about the base number that percentage is applied to, and that base was determined long before this announcement ever happened. Here's something many people don't fully realize. The size of your increase today is directly tied to decisions you made years ago. The COLA is a percentage, and percentages only grow meaningfully when they're applied to a larger base number. That base number was locked in when you chose to start claiming benefits. If you claim Social Security at age 62, your benefit was permanently reduced compared to what you would have received at full retirement age. Depending on your birth year, that reduction could be as much as 25% to 30%, and that reduction doesn't disappear. When you reach full retirement age later, it stays with you for life. So when a 2.5% COLA is applied, it's applied to that smaller, reduced amount. On the other hand, if you waited until your full retirement age, you received 100% of your primary insurance amount. And if you delayed even further, up to age 70, your benefit increased by 8% per year. In delayed retirement credits, that's not a market-based estimate. That's a guaranteed increase written into the system. Waiting from full retirement age to 70 can raise your monthly benefit by roughly 24% to 32%, depending on your specific timeline. Now let's make this practical. Imagine two retirees, one claimed early and receives $1,500 per month. The other delayed and now receives $3,000 per month. A 2.5% COLA, applied to $1,500, produces about a $37 increase. The same 2.5% applied to $3,000 produces about a $75 increase. Same percentage, very different outcome. Over time, those differences compound. Each year's COLA builds on the previous year's total. So the person who started with the larger base continues pulling further ahead in absolute dollar increases. This is why announcements like the $500 headline affect people so differently. It's not just about this year's adjustment. It's about the lifetime structure of your benefit. The system rewards patients with higher base benefits. And higher base benefits magnify every future percentage increase. And if this kind of clarity is helping you understand how these pieces fit together, take a quick second to subscribe so you can stay ahead of future changes. Social Security is complex, but when you understand the rules, you gain leverage. Now, let's continue. We also need to talk about working while collecting benefits, because this is another area filled with confusion, and it directly affects how much money you actually receive. Before full retirement age, if you are under your full retirement age, and you're collecting Social Security while still earning income from work, there is an earnings limit for 2025. That limit is $23,400. If you earn more than that amount, Social Security withholds $1 in benefits. For every $2 you earn above the limit, that can feel like a penalty. If you're depending on that monthly check, and suddenly part of it is withheld, it may seem like you're losing money. But here's the part most people don't hear. That money is not gone forever. When you reach full retirement age, Social Security recalculates your benefit. They adjust it upward to account for the months when benefits were withheld due to excess earnings. In other words, the system gives you credit. Later, the year you reach full retirement age, the rules shift. The earnings limit jumps significantly to $62,160 for 2025. And instead of withholding $1, For every $2 above the limit, it becomes $1 withheld. For every $3 above the limit. Even more importantly, this only applies to earnings before the month you actually reach full retirement age. Once you hit that milestone, the earnings limit disappears entirely. You can earn any amount part-time, full-time consulting, self-employment, and your Social Security benefit will not be reduced. This matters because many retirees today continue working, whether by choice or necessity. Some want to stay active, others need the income. Understanding how the earnings test works helps you avoid unnecessary fear or poor planning decisions. If you're close to full retirement age, it may make sense to coordinate your work income strategically around that timeline. If you're well below full retirement age, knowing how the limit affects your current payments prevents surprise withholding. And remember, any COLA increase is still applied to your full calculated benefit, not just what you happen to receive after temporary withholding. The underlying benefit continues adjusting, even if part of it is being withheld due to earnings. In the next section, we're going to zoom out even further, because while we're talking about increases today, there's a bigger, long-term question many retirees are quietly asking: what does the future of Social Security actually look like? And how should that reality influence the way you plan from here? Now, let's step back and look at the bigger picture. Because any conversation about Social Security increases eventually leads to one uncomfortable but necessary question: how stable is the system long-term? According to the most recent trustee reports, the Social Security Trust Fund reserves are projected to be depleted around 2033 if no legislative changes are made. And I want to explain carefully what that actually means, because the word depleted causes a lot of panic. It does not mean Social Security disappears. It does not mean checks suddenly stop. What it means is that once the trust fund reserves are exhausted, the program would rely solely on incoming payroll taxes. Current projections suggest that payroll taxes alone would be sufficient to cover about 79% of scheduled benefits. In simple terms, if Congress took no action at all, benefits could face an automatic reduction of roughly 21%. At that point now, historically, lawmakers have stepped in before worst-case scenarios unfold. Adjustments have been made in the past through tax increases, benefit formula changes, or gradual age adjustments. But the uncertainty itself is important. When you hear about a 2.5% increase today, it's good news in the short term. But retirement planning doesn't operate on one-year time. It operates on decades. This is why I consistently emphasize that Social Security was designed as a foundation, not a complete retirement plan. When the program was created in 1935, life expectancy was shorter, retirement periods were shorter, and the system was meant to prevent poverty among older Americans. It was never designed to fully replace pre-retirement income. For most households over time, though, millions of retirees have come to rely on it as their primary or only source of income. That reliance makes every announcement feel amplified. A $48 increase matters. A $75 increase matters. And for households that qualify for multiple benefits, a few $100s can feel transformative. But long-term security requires diversification: pensions, retirement savings, part-time work, annuities, investments, or other income streams. The more dependent you are on one source, the more vulnerable you are to policy shifts. And here's something that concerns me deeply. Many retirees don't fully understand their own benefit structure. I've spoken with people who have been collecting Social Security for years and still cannot clearly explain how their payment was calculated. They don't know their full retirement age, they don't know how much They permanently reduce their benefit by claiming early. They're unsure whether they qualified for spousal benefits, survivor benefits, or divorced spouse benefits, and, in some cases, they never reviewed their earnings record for accuracy. That lack of understanding isn't a reflection of intelligence. The system is complicated by design. The rules span thousands of pages of regulations. But complexity doesn't remove consequences. If you claimed at 62 without realizing the long-term reduction, that decision continues, affecting every COLA increase you receive today. If you were eligible for a higher survivor benefit, but didn't apply correctly, you may have left money on the table. If errors exist in your earnings record and go uncorrected, your base benefit could be lower than it should be. Financial literacy in retirement isn't about becoming an expert in tax code. It's about understanding the handful of rules that directly influenced your income, and those rules can add up to tens of thousands of dollars over a lifetime. Even something as simple as knowing that waiting from full retirement age to 70 increases your benefit by 8% per year can change a retirement trajectory dramatically. The key point here is empowerment. The system may be complex, but it is not random. There are formulas. There are timelines. There are eligibility categories. And once you understand them, you gain control over how you interact with the system, instead of feeling at its mercy. In the final part of this conversation, I want to shift from explanation to action. Because whether your increase is $48, $96, or something much larger due to combined benefits, there are specific steps you can take right now to protect and potentially optimize your retirement income going forward. So let's turn all of this into something practical, because information is only powerful if you use it. Whether your increase this year is modest or substantial, there are steps you can take right now to make sure you're not leaving money on the table, and that you're prepared for whatever changes come next. First, if you haven't already, create a My Social Security account on the official SAA's website. This is your direct window into your personal benefit record. It allows you to see your earnings history, your estimated benefits at different claiming ages, and your official statements. Many people are surprised when they log in for the first time. They either discover errors in their earnings record or realize they never fully understood what their projected benefit actually was. Since your benefit is calculated based on your highest 35 years of earnings, even one missing or incorrect year can reduce your lifetime payout. Fixing those errors early matters. Second, confirm your full retirement age. It's not the same for everyone. Depending on your birth year, it could be anywhere between 66 and 67. Knowing that exact age gives context to everything else. Earnings limits, reduction percentages, delayed retirement credits. Without that number, it's difficult to plan strategically. Third, if you're married, divorced after at least 10 years of marriage, or widowed, take time to explore spousal and survivor benefits carefully. Spousal benefits can provide up to 50% of your spouse's full retirement amount. If claimed at full retirement age, survivor benefits can be even more significant, sometimes, allowing the surviving spouse to step up to the higher benefit. In certain situations, coordinating when each spouse claims can dramatically increase total household lifetime income. These rules are nuanced and they are often misunderstood. Fourth, understand how taxes affect your benefits. If you have income from retirement accounts, pensions, rental property, or part-time work, your Social Security may be partially taxable. Planning withdrawal strategically can sometimes reduce how much of your benefit is subject to tax. Even small adjustments in timing can make a difference over years of retirement. Fifth, prepare emotionally and financially for the reality that Social Security alone may not sustain the lifestyle you want. Long-term, that doesn't mean panic. It means awareness, budget carefully, review expenses, annually explore supplemental income options if needed. Every additional source of income reduces pressure on your benefit and gives you more flexibility. Now, let's bring this back to the $500 headline that started this conversation. Yes, there are real increases taking effect. Yes. Millions of retirees will see higher deposits beginning in February. And yes, in certain complex multi-benefit situations, combined increases could approach several $100s per month. But for the average retiree receiving a single standard retirement benefit, the increase will reflect the 2.5% COLA. Meaningful but far smaller than the headline number. The difference between expectation and reality is where confusion lives, and confusion can lead to poor decisions. Spending increases that aren't sustainable. Disappointment that erodes trust. Or missed opportunities to optimize benefits correctly. The key is understanding your individual situation, your work history, your claiming age, your marital status, your Medicare premiums, your tax exposure. Those details determine your outcome far more than any headline ever will. So when you see large numbers circulating online, pause. Ask, does this apply to my specific structure of benefits? What is my base amount? How do deductions affect me? When exactly will I see the adjustment? Those questions protect you from surprises. At the end of the day, no one will ever care about your retirement income as much as you do. Government systems operate broadly. Headlines speak generally. But your retirement is personal. The more you understand the mechanics behind your benefit, the more confident you become, not just about this year's increase, but about every financial decision moving forward.